Do you ever feel like traditional pensions are a scam? Many people do. The idea of working tirelessly for decades only to receive a modest payout that barely covers your retirement expenses is disheartening to say the least. But what if I told you there's a way to make $3,000 per month with just $100 per month in investments? Sounds too good to be true? Well, it's not, and in this video, I will show you exactly how to do it through the power of passive investing, specifically using dividend income. I'll show you the drip strategy and the snowball effect. I'll also show you the selection criteria for choosing stocks and provide a top 5 stock portfolio. In the end, I'll show you how this portfolio can generate over $3,000 per month with a contribution of only $100 per month. Let's get started and make your $100 work for you. But first, let's understand dividend income. At its core, a dividend is a portion of a company's earnings distributed to shareholders, usually in the form of cash or additional stock. Companies that pay dividends are typically well-established and financially stable, providing investors a steady income stream. This makes dividend-paying stocks an attractive option for those looking to build a reliable passive income stream. The beauty of dividend income lies in its simplicity and consistency. Unlike capital gains, which require the sale of stock to receive a profit, dividends provide regular payouts without needing to sell any shares. This allows stock investors to benefit from both the income generated by dividends and the potential appreciation of the stock's value over time. Essentially, you're getting paid to hold on to your investments. For instance, consider a company like the Home Depot, which has a forward dividend yield of 2.48% and a 3-year dividend growth rate of 11.27%. Companies like this not only provide a solid yield but also demonstrate a commitment to increasing shareholder value over time. Okay, so after dividends, there's a strategy that can be used to compound your returns, and that is called the drip strategy, aka the snowball effect. The dividend reinvestment plan, commonly known as DRIP, is a powerful strategy that allows investors to reinvest their cash dividends into additional shares or fractional shares of the underlying stock on the dividend payment date. This process can significantly improve the growth of your investment portfolio over time thanks to the compounding effect. Let's break down how DRIP works and why it's beneficial. When you receive dividends from your investments, instead of taking them as cash, you use those dividends to purchase more shares of the same stock. This reinvestment is often done without any commission fees, making it a cost-effective way to grow your holdings. As your number of shares increases, so does the amount of dividends you receive in the future, leading to a compounding cycle of growth. The compounding effect, often referred to as the snowball effect, is where the real magic happens. Just like rolling a snowball down a hill, it starts small but grows larger as it accumulates more snow. Similarly, with DRIP, your initial investment grows as it accumulates more shares, which in turn generates more dividends, allowing you to buy even more shares over time. This can lead to exponential growth in both your share count and the total value of your investment. Suppose you invest $100 per month in a stock that pays a 3% annual dividend yield. Initially, your dividends might be small, but as you continuously reinvest them, your share count increases. Each additional share generates its own dividends, which are again reinvested to purchase more shares. After several years, the dividends alone can make a substantial contribution to your portfolio's growth, far exceeding your original monthly contributions. The snowball effect is particularly powerful over the long term. Furthermore, DRIP can be especially advantageous during market downturns. When stock prices drop, the dividends you reinvest purchase more shares at lower prices, positioning your portfolio for greater gains when the market recovers. This dollar-cost averaging effect helps mitigate the impact of market volatility and can lead to improved long-term performance. Now remember, in the end, I'll show you how this strategy can generate over $3,000 a month for you with a contribution of only $100 per month. So, knowing the strategy is one thing, you need a good selection of dividend stocks. This is probably the most important factor for building a successful passive income portfolio. The goal is to identify companies that not only pay dividends but also have the potential for dividend growth and capital appreciation. Here are some key criteria to consider when choosing dividend stocks. First, look at the dividend yield, which indicates the percentage of a company's share price that's paid out as dividends each year. A higher yield can be attractive, but it's important to ensure that the yield is sustainable. Extremely high yields might be a red flag, suggesting that the company might not be able to maintain its dividend payments in the long run. Next, consider the payout ratio, which is the proportion of earnings paid out as dividends. A lower payout ratio generally indicates that the company has room to grow its dividends in the future. A payout ratio below 60% is typically considered healthy and suggests a balanced approach to dividend distribution and earnings retention. The dividend growth rate is another important metric. Companies with a consistent history of increasing their dividends are often more reliable. Look for companies with a strong track record of dividend growth over several years. Some industries are more stable and resilient, making their dividends more reliable. Consumer staples, for instance, tend to be more stable than cyclical industries. Companies in stable industries with a track record of steady growth make reliable choices for dividend investors. Okay, now that we understand the criteria for selecting dividend stocks, let's look into the top 5 dividend stocks that can help you achieve your goal of making $3,000 a month with just a $100 monthly investment. These stocks have been chosen based on their strong financial health, reliable dividend payments, and growth potential. My first pick is the Home Depot, a leading home improvement retailer known for its robust financial performance and consistent dividend payments. With a forward dividend yield of 2.48% and a 10-year dividend growth rate of 17.57%, HD stands out as a reliable choice for dividend investors. The company has a market cap of $360.31 billion and a history of strong earnings, making it a stable option in the consumer discretionary sector. Next is Automatic Data Processing. This company offers business outsourcing solutions and is a key player in the human resources industry. Its market cap is $108 billion, and it has a track record of financial stability. ADP offers a forward dividend yield of 2.27% and a 10-year dividend growth rate of 12.64%. Then there's the Nordson Corporation, an industrial machinery company known for its innovative products and strong market position. NDSN has a forward dividend yield of 1.15% and an impressive 10-year dividend growth rate of 14.22%. Likewise, Broadcom, a major player in the semiconductor industry, offers a forward dividend yield of 1.33% and a dividend growth rate of 34.63%. And finally, I have Kroger, one of the largest supermarket chains in the United States, providing a stable source of income for dividend investors. KR has a forward dividend yield of 2.35% and a dividend growth rate of 13.66%. These 5 companies have shown strong financial health, reliable dividend payments, and potential for growth, making them excellent choices for a dividend-focused investment strategy. Home Depot offers stability and a solid dividend yield in the consumer discretionary sector. ADP provides consistent dividend growth in the industrial sector. Nordson Corporation, with its impressive dividend growth rate, adds a strong performer from the industrial machinery sector. Broadcom offers exposure to the technology sector with robust financial metrics. And finally, Kroger adds stability to the consumer staples sector with its steady financial performance. In the end, I'll show you how these stocks together in a portfolio can generate over $3,000 a month with a simple contribution of only $100 per month. So let's dive in and make your $100 work for you. This is great. You now have the stocks. The next step is to start allocating your initial investment equally among the 5 stocks. This ensures a balanced approach and reduces the risk associated with putting too much capital into a single company or sector. For example, if you're investing $100 a month, you might allocate $20 to each of the 5 stocks. This equal distribution provides a solid foundation for your portfolio. But you might be wondering, what if some of these stocks are priced over $20, making it challenging to buy whole shares with a small monthly investment? The solution is to buy fractional shares, which allow you to purchase a portion of a share rather than a whole share. Many brokerage firms now offer fractional share trading, allowing you to invest in high-priced stocks without needing to buy an entire share. By purchasing fractional shares, you can still allocate your $20 evenly across each stock, ensuring that your portfolio remains balanced and diversified from the outset. So now that you have a portfolio, let's project its future performance to see whether a $100 per month investment can grow into a meaningful portfolio that generates over $3,000 per month. To do this, we first need to calculate your portfolio metrics, and you can do this by adding all the metrics of each stock, then dividing by the number of stocks in the portfolio. For this portfolio of 5 stocks, we have a portfolio dividend yield of 1.92%, a portfolio growth rate of 18.54%, and a portfolio value appreciation of 16.72%. Based on these metrics, if you invest $100 each month, your total invested amount will be $1,200 per year. Starting from there, the year-end portfolio's value is projected to be approximately $2,224 after the first year. This early growth sets the foundation for substantial future gains. Maintaining your $100 monthly investment, your portfolio will have grown significantly after a decade. Your total contributions after 10 years will amount to $12,000, but thanks to the compounding power of dividends and share price appreciation, your portfolio itself is projected to be worth around $59,669. Over the next 20 years, your total investment after 20 years will be $24,000. However, the value of your portfolio is projected to reach approximately $239,800. And by this time, the value of your portfolio is projected to soar to about $1,480,366. The dividends generated by your investments will also grow substantially. After 30 years, your annual dividend income is projected to be $39,943, equating to a monthly dividend income of approximately $3,329. The total value added to your portfolio over 30 years is projected to be $1,456,366. This includes $1,224,580 from capital appreciation and $231,786 in monthly dividends. If you like this video, subscribe to my channel for more financial advice. See you in the next video.